It's not gold going up, but it's the currencies going down, in this case, the dollar. It's the currency falling in terms of its purchasing power. That is why the Chinese, the People's Bank of China, are buying gold. It's not so much they're buying gold, they're selling dollars. And, do they want to buy another currency? No, they don't. They don't want to buy another, they don't want to buy euros because it's exactly the same story, or sterling or whatever, or even Japanese yen. They don't want to buy those. So where else do you go? You get out of fiat and you get into real money, which is gold. And that's what they're doing. And this is why there's so much speculation, if you like, about China's long-term intentions in terms of guaranteeing the value of the yuan. Will they go onto a gold standard?
The People's Bank of China continued its gold-buying streak in April, marking its sixth consecutive monthly purchase by adding 2.2 tons to its reserves. This brings China's official gold holdings to 2,295 tons, now accounting for 6.8% of its total reserve assets. This ongoing accumulation aligns with growing speculation that China may eventually back its currency, the yuan, with gold. Alasdair Macleod, a well-known financial analyst, has repeatedly warned that such a move could dramatically shift the balance of global financial power. China's interest in gold is not new. Since 1983, when the People's Bank of China was legally mandated to collect gold and silver for the state, the country has steadily built its reserves. By 2002, China had become the world's largest gold producer and later began actively encouraging its citizens to invest in gold as well. The current rise in state and public demand suggests that gold plays a much larger strategic role in China's long-term financial planning. Meanwhile, the global gold price has remained strong despite periods of volatility, holding near the $3,250 level during European trading hours on Monday. Investor demand for gold as a safe haven surged following an unexpected downgrade of the U.S. government's credit rating. Moody's reduced the U.S. sovereign rating by one notch to AA1, citing concerns about the growing national debt. This decision was announced shortly after a House panel approved former President Donald Trump's tax cut bill, which analysts warn could add trillions more to the national debt burden. The weakening U.S. dollar, driven by dovish expectations from the Federal Reserve, has further supported gold prices. The dollar's struggle to attract investors has made gold even more attractive as an alternative store of value. According to Macleod, these events underscore a deeper issue. The entire global financial system, built on credit-based assets, is fundamentally broken. He and other experts continue to advise moving out of traditional financial assets and into tangible stores of value like gold. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
People will have to understand, put this into context, they have to understand it's not gold going up, but it's the currencies going down, in this case, the dollar. It's the currency falling in terms of its purchasing power. That is why the Chinese, the People's Bank of China, are buying gold. It's not so much they're buying gold, they're selling dollars. And, do they want to buy another currency? No, they don't. They don't want to buy another, they don't want to buy euros because it's exactly the same story, or sterling or whatever, or even Japanese yen. They don't want to buy those. So where else do you go? You get out of fiat and you get into real money, which is gold. And that's what they're doing. And this is why there's so much speculation, if you like, about China's long-term intentions in terms of guaranteeing the value of the yuan. Will they go onto a gold standard? There's no doubt about it that China has been accumulating gold ever since the People's Bank of China was appointed by law back in 1983 to handle the Communist Party's acquisition of gold and silver. That was 1983. They accumulated as much as they wanted up until 2002, when obviously they decided that the state had had enough. And incidentally, they became the largest nation by gold mine output. And that was a deliberate act of policy. They also imported doré, and they're still being importing gold from outside China, in particular from our markets. In 2002, they decided that they'd got enough gold, and it was now the time for private individuals to acquire gold. Why? Well, if you go back to Marxist theory, and this is what they were teaching in all the universities in China, really from the time of Mao Zedong all the way up until fairly recently. They're probably still teaching it as far as we may know. But they've been saying that capitalism will eventually fail, and that's once it's failed, that the next step is to go into the sort of the communist. I think it would be wrong to think that it's dollar for dollar coming out of equities and bonds and going into gold, because there will be huge losses. The point is that when you get a credit bubble imploding, other than businesses going bust, which means that the debt is no longer valid, which wipes out the credit, what happens is that the value of credit goes down. And here we've got several considerations. I mean, we've got the consideration of equity values. That's the first thing. You've got equity values as collateral for the banking system. You've got the falling values of bonds. And on top of that, of course, you've got the falling value of currency, because currency is credit. I mean, I know a lot of economists think that currency is money. It's not, it's credit, because it's on a balance sheet of a central bank. And then this brings me to a final point, which I actually wrote about in my Substack today, and that is central banks. Central banks who issue the currencies, fiat currencies, are themselves technically bust. I mean, just look at the losses on the Fed's balance sheet, on the Bank of Japan's balance sheet, on the Euro system's various balance sheets, you know, the ECB, the Bundesbank, the Bank of France, and Banca d'Italia, and all the rest of them. The problem that they have is that having gone into QE, they've basically, what they did was they pushed down bond yields to the lowest possible level and then went in and bought bonds. That's effectively what they did. This is what QE is. So they've all got huge losses. If these central banks were private enterprises, the directors would be in jail for trading fraudulently. But, you know, this doesn't apply to governments. Governments have a special position. And, of course, we all think that governments are wonderful and they're all trying to do the right thing. Yeah, this is a load of rubbish, actually. I mean, the fact is the whole system is bust, which is why I've been saying get out of credit. We're seeing the bubble is imploding, beginning. Is that if you look at this credit bubble in combination with the tendency for tariffs to be increased. I don't think it's just President Trump. I mean, you know, he's probably set off.
He's opened Pandora's box, definitely.
Yeah. But I mean, you're going to get you're going to get Europe, you know, the European Union sort of, you know, responding with extra tariffs. I mean, you know, they're all going to be doing it one way or the other. The problem is that if you look at the combination of tariffs and the credit bubble bursting, ask yourself, when did we last see this? And the answer was 1929, the bursting of the late 20s credit bubble, and the introduction of the Smoot-Hawley Tariff Act 1930. We have got exactly the same thing today. I would argue that it is potentially worse today, because when you go back to the 1930s, the US economy in particular was a lot, you know, I mean, they produced more and more of their own stuff, if you like. So that the effect of the Smoot-Hawley Tariff Acts, which raised tariffs by probably a minimum of about 20% across the board, had that very, very bad effect. And I think something like 1,000 economists wrote to President Hoover and said, don't sign this into law. He signed it into law in early 1930. And the result was that Wall Street went down and down and down. I mean, it had a rally from the initial sell-off in October to November 1929. Then, of course, it recovered a bit, and then it went down and down and down and lost close to 90% of its value top to bottom. And 9,000 banks went bust. Oh. That was the situation then. I mean, we've got the same dynamics today. The only difference is that we don't have a gold standard guaranteeing, if you like, the value of credit, so long as that credit was sound.
Silver's expanding role in technology and green energy is transforming it into a compelling investment asset in today's evolving economy. Its growing industrial utility provides a strong foundation of demand that gold, primarily a monetary metal, lacks. As silver becomes increasingly essential in applications such as solar panels, electric vehicles, and electronics, this industrial demand serves as a stabilizing force that can support prices even amid market volatility. Market analysts, including those at MarketWatch, suggest that if industrial consumption continues to grow while mine supply remains tight, silver could face significant upward price pressure in the years to come. Unlike gold, which primarily serves as a store of value and hedge against inflation, silver occupies a dual role. It is both a monetary asset and a vital industrial component. This duality gives silver a unique position in the investment landscape. Historically, silver has often followed gold's lead during times of economic recovery and monetary uncertainty, only to outperform it later. After the 2020 COVID-19 market crash, gold rose by 8%, while silver surged by an astonishing 73%. A similar pattern was observed after the 2008 financial crisis, with silver gaining 81% compared to gold's 44%. These examples highlight silver's tendency to act as a high beta version of gold, reacting more dramatically when investor sentiment shifts. Alasdair Macleod highlights a deeper structural trend in the silver market, citing data from the Silver Institute that reveals a recurring annual shortfall in silver supply relative to demand. This persistent gap raises questions about how the market has remained balanced. Macleod suggests that China, which holds substantial undisclosed silver stockpiles, may have been quietly filling this gap. Let's get back to the interview.
As far as they're concerned, if they can see that capitalism in the West is going to fail, then obviously fiat currencies would go with it. That's why they had a gold policy. And incidentally, it's also why they had a silver policy, which, of course, I think very, very few people really realize. I mean, it's interesting. I attended a conference in New York, which I was speaking at. That must have been about 2011, I think probably about 2013. So we're talking a bit over 10 years ago. And there were lots and lots of silver exploration companies exhibiting at this conference. And at the time, there was a lot of, sort of conspiracy theory stuff about how JP Morgan were banging the market every 5 minutes. And then you had, what was her name? Blythe Masters, who was head of the commodity side. She deliberately went on I think it was CNN, to make it absolutely clear that JP Morgan did not take positions in the silver market. Now, of course, everybody running the conspiracy theory sort of thought, well, yeah, this woman's lying. But I can tell you, I've known people like Blythe Masters, and they are extremely careful about what they say in public. They really are. There's no way she was lying. So we know that. So going back to the conference, I asked these silver miners, I said, right, when you produce your silver output, doré, whatever, how do you turn it into cash to pay the wages and pay all the energy bills and all the rest of it? And they all said exactly the same thing. A man from Glencore comes around, he assesses the value of the doré, and then they're paid by a bank, which presumably was JP Morgan, because if we're talking about a large lot like Glencore, it's obviously JP Morgan. It's then shipped off, and I said, well, where's it shipped off to? So, well, we don't know, but I mean, presumably China, but we don't actually know for certain because it's not our business anymore. I mean, we're just paid when it leaves the site. And then if you look at the other end of it, obviously JP Morgan would also be acting for China on the futures market. So what we have, and it's quite easy to understand, what we have is we have silver in the form of doré, but it's still silver, bypassing the market and then being hedged in the market. So that was the suppression.
Oh,
yeah. And they were doing this. They've been doing this for ages. And bear in mind that China is something like the 5th largest producer of silver in the world itself. I mean, she produces a lot of silver, and she was importing this stuff. I mean, at the time, it sort of played into her hands because refining silver isn't a very environmentally friendly process. I think the Canadians pretty much stopped it. So, I mean, the Chinese were quite happy to do it. And so they accumulated a hell of a lot of silver. And if you look at, the Silver Institute's numbers and how, there's always a shortfall, certainly in recent years, of supply on demand. I mean, where's the difference come from? I guess that China has basically been feeding the market to try and control the price. Of course, they're the largest global manufacturers of photovoltaic cells. I mean, they've got every reason to have a huge stock of silver. Mm-hmm. The other thing I discovered, which was fascinating, was that China's exports in 2023 of silver, I think the figure was something like 250 million ounces. It matched pretty well exactly the Silver Institute's shortfall on its assessment. Now, the other thing that was interesting is if you look where the silver was sent, it was sent to London, it was sent to Hong Kong. I think Singapore was in there as well. Most of it going to those centers. Now, these are not large consumers of silver, but they are financial markets. So, that tells me that they were suppressing the price. We now have a situation where I just wonder whether it's in their interests anymore to continue to do that. And so far as I can see, the 2024 exports of silver have been significant, but not to financial centers. So I think there's a sort of change in China's thinking. Very, very interesting. China has accumulated huge quantities of gold. Now, if you look at Russia, apart from what the central banks got, which I think is 2,000 tons or something, I'm told by fairly well-informed sources that there are two wealth funds. One is called the Grot Fund, believe it or not, Those two funds have got something like 10,000 tons of gold between them. That's what we're told. So they've got around about 12,000 tons of gold. Not only that, but they're accelerating their mine output. They're now, I think, joint second largest producer with Australia, something like that. So this is the central bank holding is about 2,000 tons. There's another 10,000 held in various principally two wealth funds.
Okay.
But when it comes to mine output, I think we're looking at about 350 tons. I mean, this is off the top of my head. Russia could go onto a gold standard tomorrow. I mean, it's fascinating how, the propaganda, the anti-Russia propaganda, because of the war and because of Putin and all the rest of it, is such that you get serious writers, economic commentators saying that Russia's bust. It's not. I mean, its debt to GDP is less than 20%. If you look at the tax rate for ordinary people, income tax is around about 13%. I mean, if you make a lot of money, you pay 15%. Corporation tax is about 25%, which is the same as it is in the UK, similar, I think, in America and Canada. But, the inflation rate is high. Yeah, I mean, it's running at something like 8%. Now, I don't know whether that's because they actually report a proper inflation rate, which we don't. I mean, John Williams would argue that we've had 8% inflation and more for some considerable time in the United States. But the difference is that in Russia, people's wages have been rising very, very sharply. I mean, if you're employed, I think there's a reasonable level of employment, then you're getting wage rises of, sort of 20, 30%. I mean, this is against an inflation background of, around about 8%. And so what banks are doing is banks are encouraging people to save. And these guys are saving, which we don't do. They have an economy which actually could switch, very, very quickly into a gold standard. Whereas, can you imagine us doing it? No way.
China's continued accumulation of gold, paired with its deepening influence in the silver market, reflects a strategic recalibration of its financial arsenal, with the yuan potentially inching closer to a gold-linked foundation and silver gaining traction as both an industrial workhorse and investment vehicle. The global monetary order is quietly evolving. The backdrop of rising U.S. debt, downgraded sovereign credit, and diminishing confidence in traditional financial systems only sharpens the appeal of hard assets. These shifts suggest a deliberate move by major economies to diversify away from debt-laden models and re-anchor value in tangible, finite resources, as global power centers adjust their financial strategies. Could the growing reliance on precious metals signal a broader transformation in how monetary value is defined and protected? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.